Hello. So let us look at what we refer to as a receivable versus what we refer to as a payable. Okay. So let us understand what brings about receivables and what brings about payables. Okay. So let us use this a simple illustration where we have this business that is buying some goods from this supplier. Okay. On credit. Okay, and this is basically a credit purchase. So the supplier gives this business the goods, but they don't pay for now. They will pay later in future. Okay, so they agree, like say 20 days, pay me by the 20th day from now. Okay, in 20 days. So this is a credit purchase, and it creates something where there is an obligation to pay. Okay, it's just that they have not paid now. They have not paid now, but they have the obligation to pay in future, and that is where we call this a payable. And as you can hear, it is something that you're creating an obligation to pay in future. This becomes a liability. This is classified as a liability because a liability is the obligation to sacrifice something in future. Okay, so there's going to be an economic outflow from the business in future. So this is basically what is referred to as a liability. So a payable is a liability because you will need to come and pay the supplier. Okay, so this is creating an obligation to pay for this thing in future. Now on the other hand, we have this business went and sold these goods to the customer, still on credit. Okay, so this was a credit sale. What does this, what will this cost? The customer will need to pay the business. So the business is going to receive. The business is going to receive from the customer. So in their books, they are going to recognize a receivable. They are expecting to receive something from the customer because they have already given this customer these goods. Okay, so and as you can hear, when we have an economic inflow into the business, that is basically what we call an asset. That is what we call an asset because we are going to get something in the future. Okay, so this is mostly, they're usually classified as current liabilities and current assets. Okay, because most payables should be settled within a period of 12 months, and also receivables, they should be settled within a period of 12 months. Okay, so mostly these one you'll find them classified as current liabilities and current assets. Okay, so let us look at each specific for account payable. Okay, you're going to find we really mentioned this account a lot of time when we are passing journals and creating passing journals mostly. Okay, so let us get an understanding of what an account payable is. And an account payable basically is a recording of the money a business owes a third party for goods or services bought on credit but not yet paid for. Okay, as mentioned earlier, what a payable is, they have already received the goods or services from this third party, could be a supplier. Okay, and they are yet to pay for it. So this is recorded in an account payable. Okay, so let us use this example to understand this. Nala bought 10 computers from KM traders at Kenyan shillings 100 each, expected to settle the invoice in 20 days. Note that the invoice has been issued. Okay, we record transaction in an account payable and an account receivable when the invoice has been issued. Okay, so in this case, we have 10 computers being sold at 100 each. So Nala bought them at 1 million, but they have not yet paid. Okay, so how will they record this the moment they receive? We have told Nala bought, but we don't know if Nala is buying this to sell. So if Nala is a retailer, then we need to debit inventory. That is, if Nala is buying these computers to go and sell them, that is basically inventory to them. Okay, so we are going to record 1 million. But if Nala company was let's say this LTD. Okay, Nala company was just buying these 10 computers to use them in generation of revenue. They are doing other things, not buying and selling computers. Then this would be equipment. We would be debit equipment account. Okay, it's also an asset account. Remember, for dealer, uh, here on the left side, this is assets. Okay, and when we want to increase an asset account, we debit. So here we are recognizing an increase in the inventory account. Okay, so of 10 computers. So here we're just assuming this is a retailer. Okay, Nala company is a retailer company, and the main supplier is KM Traders. So Nala is buying to sell. Okay, so we have debited to recognize that increase in inventory. Okay, then let me let me first remove this so that it doesn't confuse others. Okay, so here we are going to credit what we have. We have been given the computers. So what else do we need to recognize? We have not paid, so there is no cash movement. We need to recognize a liability in our account payable, which we are saying this amount of money we have not paid. Okay, so this is where the account payable comes in, and an account payable is basically a liability account, as mentioned earlier, and it is on the right side of this expanded accounting equation. And when you want to recognize an increase on these accounts, you credit. So here when we are crediting account payable, we are recognizing an increase in that account. Let's assume if we didn't have any thing that we have not settled, so our balance was 0, but now we have $1 million to recognize as our account payable. So here we are increasing the amount in the account payable by crediting that account. Okay, so when once we pay for this invoice, let's say in the 18th day, then there is going to be a certain movement, which is going to be, we need first to reduce the account payable, because we no longer have a debt. We no longer have something to pay because we have paid. Okay, so we are going to reduce the account payable by debiting it, and then we are going to credit what? Cash account. We are going to credit cash account because we are paying out. Remember, a cash account is an asset account as well. So now to reduce it, you credit. So this is how we go about to record when we have an account payable and what happens when that payment is settled. Okay, now let us look at an account receivable. An account receivable is money owed to a business by a third party who have already received the goods or services from the business on credit. So in this scenario, the business has received these goods or services. Okay, and the business has actually sold these goods or services to another business on credit. So what is going on? So this business has given a third party these goods or services already and issued an invoice. Okay, so how do we go about that? So here we have an example of KM Traders sold 10 computers to Nala company. One thing I want you to note in this example, so that you don't confuse yourself, so that I want you to understand how this is in. When you are looking at this example, we are looking at the books of Nala Limited. The books of Nala Limited. This is how they are going to record in their books. When we look at this other example, we are talking about KM Traders sold 10 computers to now Nala company on credit at Kenyan shillings 100, invoice to be settled in 20 days. Now we are looking at the books of KM Traders. Okay, how will KM Traders record that they sold 10 computers to Nala at these 100 Kenyan shillings on credit, and they are yet to receive that payment. Before they receive that payment, they need first to record something we call an account receivable. An account receivable. You need to debit the in account receivable an amount of 1 million. Okay, 1 million, because an account receivable is basically money owed to a business by a third party who have already received these goods and services. So Nala have already received the goods and services, but they have not yet paid for them. Okay, so the moment we record this, remember this account receivable is a what? Is an asset account. A receivable is an asset account. So an asset account, when you want to recognize an increase, what do? You debit that account. Okay, so that is why we are debiting here. And then what happens on this other end is, remember, now there's something that has happened. 10 computers have left this business. Okay, so we need to credit actually, remember, because you have actually released these computers, first you need to recognize this sale. Okay, you need to credit sales account. Okay, this is a revenue account of 1 million. Okay, so a revenue account is on the right side of the equation, and when you want to recognize an increase in the revenue account, what do? You credit this. So what you have done here is you've recognized sales. Okay, you've recognized sales, and also there is another journal that needs to be passed. Okay, depending on the inventory system that is being used. Okay, so but this one will have to introduce, let's assume for this scenario they do a period end inventory adjustment. Okay, so but if they had given us details on cost of goods, then we should be able also to recognize the decrease in the inventory account. Okay, and recognize the cost of sales, but you can do it at the end of the accounting period. Let's say if you want to look at a period quarterly or annually. Okay, or semi-annual, depends, but others do it at that particular point. Okay, so in this case, once you record this, when you get paid, what will KM traders do? They are going to debit cash. Account an amount of 1 million. Why? Because now they have received 1 million from who? From Nala company. And then they are going to credit now the account receivable, because now they have been paid, so they are not expecting any receivable from Nala anymore. So they need to reduce that receivable of 100 million because now they have received it. Okay, so this is for when we are using the system that we do the adjustment for cost of sales and inventory at the end of that accounting period, so you don't have to do it at the point of transaction. Okay, so note that this is what is happening on KM traders books, and then this is what is happening on the other side of Nala books. Nala is the one that is receiving the goods from KM on credit, and this is how they are going to record them. And then on the other side, KM is the one that is selling these goods to Nala on credit. Okay, so KM records an account receivable. Okay, and Nala that is receiving the goods records an account payable. Okay, so note those key differences, because one is expected to pay, the other one is expected to receive money from the other. Okay.